Well, thank you very much for joining us today. I'm Brad Setzer. I'm a senior fellow at the Council on Foreign Relations. It's my pleasure to welcome Andrea Presbitero and Andrés Fernandez from the IMF to introduce their new report, part of this year's World Economic Outlook analytical chapters, on how emerging economies impact growth globally, not just impact their own growth. So they title it Trading Places because we usually think of conditions in the advanced economies having an outsized impact on conditions in emerging economies. But the world's evolved, its world has changed, and it is certainly worthwhile to think about the channels through which emerging economies can impact growth in the advanced economies, and in some cases, other emerging economies. So I think we should start off with a rather simple question. What motivated you to turn the tables to look at spillovers from emerging markets? And Andrea, what were the key conclusions of your work?
Thank you very much, Brad, and good morning, everyone. Let me start just by thanking you and your colleague at the Council on Foreign Relations for inviting us to discuss this new analytical chapter of the forthcoming World Economic Outlook, which has just been released on imf.org. So I guess you said very well. I guess you gave a very nice short summary of the chapter, but let me dive a little bit more and provide a very quick overview of what the team has done for the chapter. So we motivate our analysis from the observation that after 2 decades of very strong economic growth, G20 emerging markets are now much more integrated in the global economy and account for like one-fourth of global trade. Therefore, it doesn't come as a surprise that the G20 emerging market can be an important source of spillover for the rest of the world. Our chapter indeed examined these spillovers and focus mostly on the trade channel and global value chain, even though we also look at the growing financial footprint of those economies. Our analysis showed that domestic shocks in G20 emerging market have increased over the past 2 decades and are now comparable in size to spillover from shocks in advanced economies. To give you a number, Brad, like shocks in G20 emerging market can explain as much as 10% of output variation after 3 years in other emerging markets and up to 5% of output variation in advanced economies. Clearly, not surprisingly, spillover are the largest from China, but other G20 emerging markets, such as India, Brazil, and Russia, can also have sizable spillover, especially if we look at the regional dimension. Importantly, what we find is that this spillover can create winners and losers and reallocate capital and labor across countries and sectors. For instance, we find that firms exporting to G20 emerging market benefit from stronger growth in those countries, while firms in sectors such as textile and manufacturing could actually be harmed by faster growth and stronger competition from lower wage emerging markets. Looking forward, a broad-based decline in productivity in G20 EMs, which is basically consistent with a weakening growth prospect, which is documented in the World Economic Outlook, would lead to a GDP contraction abroad. This cross-border effect differs again across countries and sectors. For instance, we find that some manufacturing sectors, such as textile, metals, and electronics, would expand as firms take advantage of the decline in supply from firms in G20 emerging markets. In such a framework, a slowdown from China clearly would be particularly costly because of China's role as a global powerhouse and also because of its strong global integration. Yet, our simulation finds the plausible acceleration in growth in other G20 emerging markets could boost world growth by 0.5 percentage point. This is basically a summary of what we find, and let me conclude with a couple of points in terms of policies. First, in a situation in which the global economic power continues to shift, clearly multilateral cooperation and international policy coordination are a first-order priority. Second, turning to domestic policies and at the national level, we argue that structural reform can help sectors that stand to benefit the most from this sectoral reallocation. At the same time, inclusive policies, including targeted fiscal support, are also needed to mitigate what some of these potential negative distributional effects of this reallocation of factors across sectors. But let me stop here and
Well, thank you. That's very helpful. I guess one broad question would be, why divide the world, today's world, into advanced economies and emerging economies? Isn't that somehow a dated frame for a world that seems increasingly to have three major poles of manufacturing industrial output, one in North America centered around the US, one in Europe centered around the European Union, the Euro area, and one in East Asia centered fundamentally around China. And then other emerging economies often are sources of inputs or commodities to size growth centers. So in some sense, why divide the world into two, not three?
Yes, I think that's a good point. I think it's a fair point. But let me push back a little bit on that and try to use this question as sort of a way to motivate a little bit how we do our analysis. So our group of countries, so we choose a group of countries, G20 emerging market, are the 10 largest emerging market, is clearly very heterogeneous. And so, as you say, one can frame the world into two or three poles, while we decide to bunch together a group of countries which are somehow different among themselves. And clearly in that group, China emerged and could actually be considered as a standalone, as you were suggesting, as sort of a center of one specific pole. That said, in the other countries, there's somehow larger, smaller footprint in the global economy. That said, what we argue in the chapter, what we show through a number of pieces of evidence, is that all of these other countries, along different dimensions, clearly show elements of importance for the global market, being that because of their role in specific commodities market, because of the participation in specific value chains, or because of stronger linkages at the regional level. So that's why we consider the G20 as a group. These are countries which, even if we account for their internal differences, grew at a very fast pace over the past 2 decades, on average 6%. Now they account for about 1/3 of the global economy. And if you look again at all of them together, they become large importers of manufacturing products and also large exporters of intermediate inputs, notably manufacturing and mining. Again, China clearly stand out as a key player here, but there are a lot of other countries which matters. In the chapter, for instance, and I sort of invite your audience to take a look at later on, and some of the figures there. We have a nice figure in which we look at participation in output and input linkages of different economies. We look at this sort of the top input and output linkages across countries and sectors. And in that chart, you can clearly see that it's not a China-dominated chart. China clearly plays a large role, but you can see in that picture that all of the other G20 emerging markets clearly play a specific role in certain sectors or in certain period. And for instance, India is particularly relevant for manufacturing, and Russia is important for as a supplier of energy commodities. Therefore, we want to sort of look at the country, the group, and as you said at the beginning, we titled this chapter Trading Places, exactly because you're interested in understand how the spillover from those countries are becoming comparable with those from advanced economies. So our main interest here is comparing this true group of countries, emerging market, advanced economies, and try to see that their sort of relative capacity in explaining economic development because of these spillovers are becoming more and more similar over time. So if I go back to your question, the suggestion of looking at US versus China, or a tripolar world with US, Europe, and China, I think that to some extent it will be a little bit of a simplification. Clearly, it would be important in several contexts on focusing on these three or two main forces. But what we want to do at the end of the day is providing sort of a fuller picture and looking at different spillover from different countries. That, again, it doesn't prevent us to focusing on China, and also compared to the US. And again, in the chapter, there is a lot of that, and you can find a lot of references in the annex of the comparison between China and the US. But our main analysis, as I said before, is really try to provide an overall picture of spillover from all the G20 emerging market through different channels. And maybe Andrés can follow up a little bit more on other dimensions.
Well, maybe I will toss out a question which may help, or you can certainly chime in, Andreas. The next broad question I wanted to raise was sort of focusing specifically on the commodity exporters, who are not all of the G20 emerging economies, but at least, a meaningful fraction of the G20 emerging economies would generally interact with the world as a commodity exporter. How do you find shocks emanating from these commodity producers propagating through the rest of the global economy?
Okay, thank you, Brad, for the question, and thanks also for giving me the opportunity to be here with Andrea, sharing with you and the audience the findings of our chapter. So on commodities, the novel aspect of the analysis that we do is we not only take a look at the commodities as a new avenue through which this growing influence of emerging markets have on the rest of the world, not only from the perspective of the producer side. We know that these emerging markets, especially the large ones that we analyze in the chapter, are very important commodity producers, but we also look at the consumer side. So we look at the producers and the consumer side of this growing footprint of emerging markets through commodities. Now, let me give you some numbers. For example, in terms of production of commodities, these emerging markets account for nearly half of global production in the three types of commodities that you usually study. These are energy, agriculturals, and minerals and metals. So just this group of 10 economies, emerging markets, account for half or even more of the production of these broad commodities. Now, with some interesting twist, which is some of these emerging markets also are well-placed producers in terms of commodities that are going to be important for the green transition. And you have Argentina, for example, being big on lithium. You have Indonesia, for example, that is being also important, an important producer in terms of nickel. Let me now turn to the role of consumers, because that's the novel part of the analysis. We know that these economies have been traditionally big in commodity production. But as Andrea was saying, as these economies have grown, they're also starting to be big players in terms of how much they consume. And by that, how much they can affect the prices, the global prices of these commodity goods. And in fact, this is something that the chapter looks at quite closely by assessing the ability of the business cycle in these economies to impact these global prices. And we do, in fact, find evidence of some of these economies impacting some global prices, global commodity prices. And this is new because, as you said from the beginning, one would generally think of these emerging markets as being small enough not to impact commodity prices. Well, we're finding that, as you say, the world has evolved, and now we're finding evidence of that. Let me stop here, but I can also chime in a bit on what Andrea mentioned, following up also on the growing role of financial flows. But let me know if you want me to continue with that.
Well, actually, let's keep that discussion going. I'd be curious what you find specifically about financial flows, particularly I think in a context where We both think of emerging economies as being the recipient of financial flows and thus vulnerable to interest rate shocks, particularly coming from the dollar. There's been a lot of work about financial only channels of propagation coming out of the United States. Yet if you look at the global savings and investment balance, a lot of big emerging economies are net suppliers of funds to the global economy, particularly when oil prices are high, but China throughout the cycle. So I'm curious what you ended up finding on through financial channels. It is a new subject.
Yes. Okay. So thanks again for that question, and because it allows us to speak about a novel analysis, which is this growing financial footprint of these large EMs into the world economy. And this is new because, as you said, we used to think of emerging markets as just recipients of these financial flows. But one of the key messages of the chapter is that these economies are now starting to provide funds to other economies, both advanced and in particular other smaller emerging markets. So let me try to unpack this gradually, because there's a lot in the chapter on this. Let me start with the more longer-term flows, FDI. There, the chapter documents how these 10 group of economies now account for around 10% of world FDI, foreign direct investment, which is almost twice the levels that we saw some 2 decades ago. So $1 for every 10 that is being spent in FDI in the world comes from these 10 large EMs, which is quite substantial. And we can talk about the role of China on that later on if you want. But on the more shorter term type of flows, namely bank flows or portfolio flows, debt and equity, we also see an important, growing financial footprint from these economies. And here the interesting thing is we observe a growing financial footprint on the flows coming into these large EMs as well as the flows coming out. Take bank flows. If you look at the flows from advanced economies into these large EMs, they've nearly doubled in size over the past 15 to 20 years. Their reliance on portfolio flows has increased 3 times if you compare the levels in the late 1990s. And this, we know, you know very well, this is probably an understatement because there's a lot of portfolio flows that are being rerouted through low tax jurisdictions. I'm also happy to talk more about that later on. But now let me also mention a couple of words on the flows coming out of these large EMs. And here bank flows is one of the things that the chapter documents. And it shows how these large EMs now provide roughly 20% of the bank flows into other smaller EMs, which is quite substantial. We also look into portfolio flows. Now, those are relatively lower in volumes, but they're growing, and you have some regional cases of these large EMs providing most of the financing in terms of portfolio flows. The case of Brazil, for example, or Mexico into other countries in Latin America is quite noteworthy. Now, let me finalize with one important twist that the chapter does in terms of financial flows, which is we, in the end, ask, what does this have to do with growth? In the end, the perennial question of, are these flows accompanying growth? Are they supporting growth? And there, the answer to that question that we address in a box is yes. Private flows have been positively correlated with growth in these economies. And in that regard, they have supported growth, which is another reason why we advocate for this positive view into the growing financial footprint. Let me stop there. Thank you.
Thank you very much. I'll ask one more question, and then I will open up the floor for questions from the audience. But I think the concluding question for me is probably the most obvious question, which is, one country amongst the 10 emerging economies stands out both in its economic heft and in its political salience. China is by far the world's largest producer of manufacturers. So spillovers emanating from manufacturing from China to other emerging economies and to the advanced economies would naturally be assumed to be quite large. And when you go through Chinese demand for commodities, China is also by far the biggest source of demand for imported energy these days, and an enormous source of demand for industrial metals, both for its growing auto industry, but also for its property sector. And there are certainly serious concerns that slowing China means negative spillovers to mineral producing countries elsewhere, just as there are very substantial concerns that expanding manufacturing production in China even further may generate more negative than positive spillovers to most of its trading partners. Complex, difficult questions. What do you guys find?
Yeah, indeed. It's a very complex question. I guess there is more than one question into one. Let me try to unpack a little bit and try to answer that. So clearly, as you said, it's a chapter on G20 emerging market, and we are very transparent on that. Like China clearly is the dominant country in that group. And again, let me reiterate that, what we show is that clearly spillover from China are the largest, but spillover from other countries are important as well. But for now, let's zoom in on the role of China, exactly because of the size of this economy, its integration, and the fact that these spillover are not only large, but they also grew quite a bit over time. So in the chapter, we have a few charts and a few pieces of evidence that show the evolution over time, and you can clearly see that in parallel with China sort of becoming more and more integrated post-accession to the WTO, you see spillover becoming larger. So we do that to unpack sort of some of the channel. Let's maybe walk you through what we do in the chapter, depending on sort of the different kind of approaches we have. And we start from a more macro picture, and then more and more we try to go and look into sort of a more granular level, what happens across sectors and firms, and then to see sort of reallocation that probably speaks more to the question you have. So at the macro level, so we have standard VAR analysis in which, if you want a number, what we have in the chapter, we find that 1 percentage point supply shock in China leads to an increase of about 0.15 percentage point in growth after 3 years in emerging markets. And the effects of advanced economies are somehow smaller. Shocks, which are demand shock in China, instead have larger effect, well, twice as large. So 1 percentage point demand shock in China leads to something like 0.3% higher growth in emerging markets. So this is basically the ballpark, the estimate that we have, which are, I would say, comparable to what other people have been finding. So in that sense, if you flip what I just told you, if you think about the slowdown in China, yes, there could be potential negative spillover to other economies, being them emerging market or advanced economies. But then let's try to go a little bit under the hood of this macro picture and try to say something in terms of which kind of sectors and firms are more likely to be affected. So we do a part of an analysis which is done at the firm level. And in that case, we can find that different shock can have different effects. You think, for instance, that's very standard demand shock from China, but again, we find this is very consistent across all the other countries. When there is an increase in demand, then what you observe is that there are some firms in other countries, being them emerging or advanced, which relies a lot on demand from emerging market, and those firms actually benefit quite a bit. And we can find that, for instance, their revenues grow much faster compared to firms which do not depend as much on demand from emerging market or China, if you want. If you look at other kind of shock, which are more supply-driven, then the effects could be a little bit more nuanced. You can think of the channel that could be still positive. If you have a supply shock, you can think that inputs which are provided by G20 emerging market are cheaper, and maybe there are even more inputs coming, there is an excess supply. And this could actually would be an advantage for firms which depend a lot on those inputs. At the same time, you can think that also like a supply shock could also push emerging markets to enter new product space, to produce new inputs, and to, in that sense, it directly compete to firms in advanced economies. And this is a challenge that the case in that case kind of displace firms and hurt firms in advanced economies. And we do a similar analysis in a trade model. We have a sort of longer run, steady state trade model. And this model, and we do simulation, we simulate a positive total factor productivity shock in G20 emerging market. We shock all the countries and all the sectors. And we find that, yes, there are spillovers, positive spillover from a positive TFP shock to other countries. This spillover will be an increase over time, again, consistent to what we found before. But again, there is a lot of variation across countries and sectors. For instance, and I guess that's the interesting answer to your question. If we look at employment, we can also look at job losses or job gains. We can find different effects. Like, for instance, we find that there are largest positive spillover to advanced economies that tend to come from shocks, positive shocks in computer and electronics, optical equipment, and textile. On the other hand, sectors that generate the largest negative employment spillover to advanced economies are wholesale and retail trade and machinery and equipment. So there are instances in which shocks, positive supply shocks in emerging market can actually lead to sort of employment losses, or firms in some sector who kind of suffer because of that. And, you know, consistent with this prediction, like, there is also existing evidence that basically show, mostly based on the Belt and Road Initiative, that basically show very similar results for sort of positive effect of the Belt and Road Initiative on upstream industries through import demand from China, and also instead negative effect due to increased competition from China in export market. So I would say, like, our results are consistent with what people have already found in sort of previous instances. But maybe Andrés want to say something more on that.
Yeah, perhaps I can chime in also from the perspective of financial flows and commodities on the important question of China spillovers. So as Andrea was mentioning, the Belt and Road Initiative is an important channel through which financial flows, like the FDI flows that I was mentioning earlier, have been channeled. In fact, what you do see in the report is that there's a considerable increase, more than the average increase in FDI flows from these large EMs into smaller EMs. So more of this FDI is being channeled to smaller EMs rather than advanced economies. And the Belt and Road Initiative is a big story in that. Bank flows also are quite important from China into other smaller EMs and account for this increase that I alluded to earlier. There's a box in the chapter that looks and zooms in on the region of Sub-Saharan Africa and documents how these financial flows have increased the footprint that China has on Africa, increasing also the exposure, as you alluded to in the question. On commodities, what the numbers from the estimated models tell us is that roughly you can think of a growth shock in China of about 1 percentage point, impacting global commodity prices by about 10%. So a growth shock, a positive growth shock in China, rises prices in commodity prices by around 10%, which is quite substantial and not too far distant from what the same type of growth shock would have in the US. So the impact of a similar shock in the US is in the same magnitude as that of China. And we also document in the chapter some of the regional effects of these, namely, for example, the impact that oil producer countries have. In the box that I alluded to on Africa, we document how countries like Angola, Chad, Nigeria, that are heavily exporters of oil, would benefit from this avenue.
That's all enormously interesting. I'm a big fan of simple quantifications that yield useful rules of thumb that people like me can make use of in multiple contexts. We are now open for questions. People who would like to ask a question or make a comment or challenge the authors in any way, including in their analytical premises, raise your hand. Federico, please start.
Thank you very much. This is Federico Sequeira. I'm the head of country research and a portfolio manager for the EM team at Morgan Stanley Investment Management. Thanks, Brad, Andrea, and Andrés for doing this. Two questions. The first one, just a basic one to clarify where the greater spillover impacts come from. How much of it is just mostly a function of the fact that emerging markets today are just larger than what they have been, call it over the last 15, 20 years, versus how much of it is it that the nature of the economic relationships are different? So that's one question. And then the second question, a little bit tying into the financial flows discussion. I'm not sure if this is a bit of outside of the scope of your work, but there is this view oftentimes that a lot of countries, especially emerging markets, aren't able to implement their own independent monetary policy. Think about interest rates. I know I'm being fast and loose with distinctions between a nominal and real, but that they haven't been able to do so because the really strong interest rate globally comes from the Federal Reserve. Do you see any evidence that is changing, that emerging markets are actually more able to conduct independent monetary policy and maybe even influence interest rates elsewhere? Thank you. Are
you collecting or are we answering, Brad? We answer. So let me maybe take the first one, and then we'll pass over to Andrés. So thanks a lot. I think the very first question is, I think it's more than just a simple clarification. I think it's really like a difficult one, something we've been struggling a bit, like in sort of in the chapter. It's not very easy to separate out the two possible effects. So one source of spillover could be the fact that those countries are actually becoming much more integrated through the global economy, and the other would be keeping constant, if you want, like the level of integration. Then there is something else that changes in the relationship of these countries and their sort of economic condition that makes spillover larger. I think it's difficult to answer that question. I would say what we can say with some degree of confidence is that the sharp increase in global economic integration, mostly in trade and GVC participation, is the key driver of the increasing spillover that we observe. And then we see in a number of exercises that we do. Like I mentioned before, we do this analysis in which we look at sort of firms which are more or less reliant on demand or inputs provided by G20 economies. And we clearly find that the exposure of firms to the shocks in G20 economies, therefore the input and output linkages, increased quite a bit over time. I think both of them, they doubled over our sample period, which is short of 20 years. Similarly, like when we estimate VAR, for instance, we do that in different ways. We can do a nice exercise in which we basically estimate the same macro spillovers, assuming that the trade weights, sort of the relationship between countries, are the same that we were observing at the beginning of the period, in the early 2000s. And then you can do the same exercise, assuming that the sort of the linkages are the one that you observed pre-pandemic in 2018. And really, if you compare the size of the spillover, you can really see that the spillover has been increasing over time. What is interesting here, and maybe I think it answers your question, in that specific case, we try to we are interested in comparing emerging markets, advanced economies, this idea of trading places. And if you were to say that spillover are more important because countries become more integrated, clearly we see that spillover increase both for emerging markets and for advanced economies. What we observe is that they increase much more in relative terms for emerging markets than for advanced economies. Therefore, over time, those spillovers between advanced and emerging become broadly comparable. So in that sense, I think there is a little bit more than just integration explaining why the spillover are coming from. And again, like we do similar exercises in other contexts that again show that integration matters. But let me stop here.
So let me take the second question, Federico, and thanks for it. It is indeed a little bit outside of the scope of the chapter on policy frameworks, but I'm happy nonetheless to take it, also leveraging from current ongoing work at the fund. I think the story in terms of monetary policy frameworks or macro frameworks in general is one, it's a positive one in terms of the enhancement of these macro frameworks and their the ability that they've given to emerging markets to withstand large shocks. Think, for example, of the huge shocks in global markets, in global capital markets that emerging markets have had to face in the past 5 years or so. Think about COVID, the tightening of advanced economies' monetary policy. These are huge shocks that these emerging markets have been able to withstand thanks to the buildup of resilience associated with enhancing these macro frameworks. Think about more independence in central banks, enhanced monetary policy frameworks. Think about the use of fiscal rules in most of them. Think about the use of macroprudential tools that have lowered the financial stability concerns. These are all positive developments that you see on average in the emerging markets, of course, with a lot of heterogeneity, of course, but on average, you do see an increase in this. The fund has provided data on both on the 3 types of frameworks that I mentioned: monetary policy, fiscal, and macroprudential, and all of those point to the direction of enhancing their macro stance. This has allowed these countries to withstand these large shocks. And to come back at one of the points in your question, it has allowed some of these economies, and the chapter documents that for the case of China, to actually affect not only global commodity prices, but also financial global variables, world interest rates, which is quite noteworthy. Who would have thought, for example, that emerging markets would be able to issue such amount of external debt in local currency and at very long maturities relative to what was the case some 2 decades ago? So I guess that speaks to the enhancement of the macro frameworks and the positive effects that this has had to emerging markets. Thank you.
Maybe I'll stick on that theme. One of the points that Andrés, you raised is that Chinese financial flows are in and of themselves emerging as a driver of performance in other emerging economies. I assume that's basically a backward-looking result reflecting lending and investments done over the previous 10 years. Were you able to pin down a question that is widely debated, namely what has happened to those flows over the past 2 years? And can you build some sort of forecast for those flows to assess whether or not that driver of growth across many of the frontier economies is going to stay the same? Is it going to go into reverse? Was this, in essence, a one-time positive China shock to what we call the frontier markets that is now in the process of reversing and becoming a negative shock?
Yes, Brad, thanks for the question. It allows me to expand a little bit more on the financial footprint of these EMs. Indeed, the China shock is, among its many ramifications, on the financial side, a big powerhouse for some of the developments that we see. The bank flows, a large portion of the bank flows that we document that increase relative to some 10 or 15 years ago are driven by China. Now, we do see just if you stick to bank flows, you do see that they peaked around 2016, if I recall correctly, and then they have gradually, but very slowly, gone down a bit. Now, the chapter doesn't do any forecast on this. Let me be clear on that. We don't do forecasts. Now, we take a retrospective look at these developments. But you can infer that where this slowdown to continue, then you could foresee that some of these financial flows are going to continue going down, and hence some of the countries that have been recipients of this might be more exposed to this. Now, on the more brighter side, I'm going to take up on some of the conclusions that Andrea highlighted, which is a key message that the chapter conveys is that together with this rise of emerging markets have come the ability to other emerging markets instead of China to pick up the pace where to China further slow down. Thank you.
I will note that anyone who would like to join this conversation can raise their hand, feel free. But I am happy to continue to press the authors in the interim. So I guess what I'd really like to hear you guys discuss is I think it's something that you actually do explicitly mention in the paper, is the impact of a sustained slowdown in property investment in China. It's sort of an obvious risk. It's a risk the IMF in its Article 4 highlighted. I think the IMF's baseline forecast is that property construction in its equilibrium going forward will be roughly half the size relative to China's economy that it has been in the past. What impacts would that shock, if accurate, based on your modeling, have? And are there any non-obvious second-order shocks that we should be aware of? And just to be a little bit mean and a little bit provocative, the other big IMF policy recommendation for China, one of your big sources of spillovers, is a 7.5 percentage point of GDP fiscal consolidation over the next 10 years. So in a standard model, a pretty big demand shock, generic demand shock coming out of China. Now, that may or may not be what emerges. It may or may not be what the IMF recommends next year. It is a recommendation that the IMF only made to take place with a lag, so China isn't supposed to immediately consolidate. But directionally, the IMF forecasts or calls for a very large consolidation. So walk us through the potential impacts of these shocks, large shocks, coming out of China.
Yes, so thanks, Brad. Let's take on these provocative questions. Let's start with the property sector and the slowdown in property sector in China. Let me sort of clarify, like you said very well already, like I think you know very well the Article 4 that has been approved by the board in February and which is been published soon after. I mean, I invite all the readers to take a look at the Article 4 for most of that and sort of the sort of most of the effect of the slowdown and the projection. But in the chapter, we really look into that from the angle of the spillovers. So what we can say, and what I think it's interesting, is try to understand what could be the propagation of a weakened property sector, the slowdown in property sector in China across different sectors and other countries. So as I said, like to step back a little for a second, our chapter does different exercises. One set of exercises use a trade model, which is a static model, which allow us to sort of design different scenarios. In the baseline, we have positive TFP shocks across all sectors, but then doesn't prevent us to design a very specific scenario. And one of these specific scenarios is exactly like a situation in which we only gonna shock a specific sector, which is the construction one in China. So here we try to mimic a significant slowdown in the property sector. And what we see is that clearly that has first-order effect domestically on China, on the Chinese economy, and this is similar to what you can see again in the Article 4. But then we look at the propagation. What is interesting is that there are like large effect, also in a significant effect in terms of reallocation in other sector. I would like flag one, which I think it's important. There are largest decline in sectoral value added in the production of energy commodities, and particularly mining, suggesting that there are upstream propagation of the Chinese construction sector through the value chain. So that's one thing which is sort of novel you can find in the standard IMF analysis of that, and which we have in the chapter. I think the more general question that you have following up is that what about like propagation of large fiscal consolidation, therefore like sort of a large negative demand shock from China. And for that, I would sort of, go back to what I said before. Like before I walk you through what is mostly like a supply shock from the demand side, clearly we see that there could be a sort of negative aggregate macro spillover, which are non-trivial. Like the number that I cited before is like 1 percentage point sort of shock, like a surprise in growing China leads to about like 0.3 percentage points lower grow in other countries, emerging and advanced. Then on how sort of this could propagate in different sectors, I would say that clearly there could be negative effect to sort of firms and sectors that tend to rely a lot on demand from China. So a compression of that demand will sort of affect firms and sectors in advanced economies, which tend to sell their products to China and emerging markets more generally.
Interesting. I think one of the biggest contributions of this paper will be its ability to help us understand in more granular detail some of these propagation channels. Lyric Hughes-Hale.
Hi, everybody. Thank you so much for this. Has sparked a lot of questions, actually, for me. One is following on to Brad's question, which is about depression in the housing industry in China. It seems that China is transferring this activity to the manufacturing sector, and this was discussed by Janet Yellen during her trip to China, that she's worried about overcapacity in China that will lead to problems not just in emerging markets but throughout the world. And then my second question is about interest rates. If this slowdown in emerging markets was caused by an increase in interest rates, particularly with the United States leading, if we can foresee interest rates falling, how will that affect what might happen going forward?
Thank you. I think we're gonna split as before, right? So on the first one, yes, we've been reading what has been happening in the last few days. I think clearly there is this connection, as you were mentioning, from the housing sector into manufacturing. And if I understand well, your question is about how the sort of spillover, sort of how this increase in manufacturing and manufacturing export, which is something that Brad also, I guess, mentioned at the very beginning, could sort of propagate through the global economy. And so this is basically turns back to what is more of a supply shock from China. And again, we're talking about China, but I think that's would apply to similar to other countries. At least our evidence in the chapter show that for other countries as well. In that case, as I said, like at the aggregate level, the picture is a little bit less certain because there could be like one could think at different channels. I said before, like there could be like positive effect for some of firms and some sectors in advanced economies. I guess the focus is what is happening on advanced economies, but clearly there could be like competition effect, sort of import competition effect coming from China. And I guess the chapter is very clear on that. We show some of these results, both like empirically, so backward looking, when we look at firm performance, we can see exactly some of these results, and also like in our simulation using the trade model I mentioned before. So we have this two sort of potential positive and negative spillover. I would say, like at the macro level, we still find evidence that even a supply shock transmits positively to other economies, including advanced economies. But again, I think that what is important is to understand that under the sort of the average macro positive spillover, there are clearly these sort of winners and losers, similar to what we already observed with the first China shock that happened a few years back. And I guess some of our results clearly point to the fact that there could be like sort of positive shocks, positive supply shock in China could hurt some sectors abroad and could lead to some job losses, particularly in manufacturing and advanced economy. This is what our simulation clearly shows. Thank you.
So maybe if I can take the second one, Lyric, thank you so much. So yes, indeed, movements in interest rates have been central for capital, both flowing out emerging markets at the starting phase of the tightening cycle, mostly in advanced economies. And now that rates seems to have stabilized or even come down a bit, we see capital now flowing back into some emerging markets, and in particular, some of the emerging markets that were more resilient. We even see some evidence of low-income countries being able to float new debt at reasonable interest rates. So it is expected that these turn of events will bring more capital and hence economic activity to these emerging markets. We nonetheless, and this is also a bit outside of the scope of the chapter, but the IMF has been warning that along with these flows back into EMs, it is important for these emerging markets to rebuild some of the fiscal buffers, for example, that were lost fighting the pandemic. Thank you.
Well, I will ask one last provocative question before concluding. I guess the sector that is probably most politically salient right now in the advanced economies is vehicles, autos. I didn't notice a lot in the discussion of the impact of a China shock on the auto sector. Is it actually possible using your model to come up with any result, given that historically China's been an importer of autos, not an exporter, and so the swing in global production won't be well captured in any backward-looking historical analysis? And I think Federico also has a question, so go ahead, Federico.
Thank you very much. So I thought the box 4.2 was a quite fascinating box on the capital flows. So on the bottom chart where you show that there is a relationship with private net capital flows and growth, I'm curious though if you only find that with growth and not for actually capital poor developing economies. So if it's just the productivity, but you still don't see a lot of integration with low starting levels of capital. And then the second question is just, has the strength of that relationship changed over time? Thank you. Thank you, Brad.
Okay, let me quickly take on Brad's second provocative questions. I think, on that one, clearly the machinery we have, some of the tools we use in the chapter would allow us to at least speak to some aspect of what you said. This is not something we have specifically done in the chapter. So as I said before, like clearly most of the analysis is sort of the empirical part of this is backward looking, but then we have the forward looking part, which is more of a modeling part, and this trade model really allow us to do specific specific shock and design specific scenarios. As I said, like the interest, at least I think even now, but even more so during the past few months when we worked on the chapter, was on the property sector, and that's justify why we did that. And then we also were interested in trying to sort of diversify out of China, and so we did some different exercises. For instance, we look at shocks to the IT sector in India, so to see a sort of different mechanism, and also to look at services rather than manufacturing. So that sort of prevented us from doing more than that. And clearly, like, this is something we're going to monitor and keep on using. And this is a question clearly on top of our priorities, because it's definitely particularly relevant. That said, I think we can still sort of have some intuition of the mechanisms through which could work. So, and which are basically the same that I discussed before, because that would be like sort of a supply shock coming from, production of cars from China, and therefore that could sort of clearly have propagation upstream and downstream, could have sort of import competition effect on the same sector abroad. So all these channels will be at play, but then sort of to quantify and being able to say, like, because I guess clearly there would be positive and negatives, and so we need sort of to put everything together and sort of balance them out. For that, yes, we need to sort of do a specific simulation. I'm pretty sure we will do that, and we'll be happy to discuss at a certain point in the future. Thanks.
So maybe I can address Federico's question on the box, and thanks for your positive view on that. I'm more than happy to talk more bilaterally on that one. So your question actually raises two of the puzzles in the literature on capital flows in emerging markets that are related, and that the box tries to speak to both of them, at least more one than other, which are these two puzzles. Why capital doesn't flow in the amount that one would expect to emerging markets, given that these countries are relatively capital scarce, and hence you would expect higher return. This is the puzzle that Robert Lucas challenged us to think about more than 3 decades ago. And then the other puzzle is, why do we see that capital is being properly allocated? So do we see that even though the volumes are relatively lower than one would expect, do we see capital at least flowing to the countries where growth is picking up? So then what the box says, one of the messages in terms of the second puzzle is, it is flowing in the right direction, in the sense that it is countries that are growing at the highest pace that are receiving these private flows. Now, in terms of the volumes, why don't we see more volumes in terms of capital flows into EMs? Well, the chapter takes the more benign or optimistic view that we have seen, and this is the growing financial footprint that I discussed earlier. There are distortions, and Lucas was the first to identify distortions such as financial frictions, there's capital restrictions, there's the role of institutions and the build-up of better institutions that prevent capital from flowing. But I guess the message is we're seeing more capital flowing in, and it's flowing in the countries that are growing the most. Now, on your final question, has this changed over time? The answer is the volumes have increased, but the allocation, the proper allocation in terms of countries growing at a faster pace, receiving these flows, hasn't changed that much. The last document on this, academic document, went up to the early 2000s, and what we do in the box is extend the analysis, and we find pretty much the same thing, that private flows have been properly allocated to countries that grow faster. Thank you.
Well, we've reached the end of our allotted time. I remind the audience and the speakers that this was an on-the-record session, and my only remaining task is to thank Andrea and Andrés for taking the time to speak with us today, and to congratulate them on a well-executed analytic chapter, which I'm sure will be a reference going forward. There's a lot of intriguing detail, and I think many of the conclusions and insights are quite nuanced and valuable. Again, thank you. And that concludes the session. Thanks.
Thank you very much. Thanks for having us, Brad.
Thank you.